Congratulations, you've decided to step into the world of home ownership. It's time to buy your first house, but you need to prepare for the residential loan mortgage application interview at the bank. In this video, what documents, how to prepare as stress-free as possible for that application interview and improve your chances of getting approved, coming up in this video. Your journey towards home ownership should be an exciting one and even something that you look forward to. However, if you are a first-time home buyer, oftentimes it can also be a very stressful time because a lot of people fear the mortgage application process just in general. And a lot of that has to do with the financial documentation that you need to gather up, collect, sort through, and then submit to your lender for review. You might want to get yourself a pad and paper and jot down some notes, or better yet, just refer back to this video because this is not going to be complicated. Let's get right into it with income. Banks need to see that borrowers have the capacity or income to repay their monthly obligation. And what that means to you is that you need to provide evidence of your income in the form of pay stubs. So if you have a regular job where you're W-2'd, this is pretty simple. Just gather up the last months of your income statements or pay stubs. If you are self-employed or have some type of a side hustle where you get income that is 1099, or you own a small business on the side or something, and you're just classified as self-employed of some type, then what you would do is also gather up your last 2 years of tax returns. Next is going to be assets. Banks want to make sure, among other things, that borrowers have enough funds to cover the cost of the down payment. You're going to have to show evidence that you have enough savings in the bank and that it is your money. The way you do this is by providing the last couple of months of bank statements. Specifically, just to be safe, you're going to want to collect the last 3 months of all of your bank statements that you want the bank to consider for the mortgage application. Now, a lot of times, depending on your credit history and your overall qualifications and the loan or lender that you're going with, you may only be asked to provide 2 months or even fewer than that in terms of your bank statement. Next is going to be your credit. Credit is important as well. Obviously, banks want to see that you have a reputation of paying on time. Credit is very important, but you don't have to actually provide the credit report. The bank will get a credit report, and you just have to basically be aware of that. And what you could do though, if you really wanted to prepare, try to get your credit report in advance of a mortgage application. So what you want to do is go online and go to the government's credit reporting website called annualcreditreport.com. And when you go there, or you can go to another one as well, doesn't have to be that one, but go to one, hopefully go to one that's free or very low cost. What you want to do basically is just get a copy of your credit report to see in advance what's on there, just in case there are any mistakes that you need to correct or any items that you just need to address, maybe any late payments that you might need to dispute if there's a disagreement between you and one of your prior creditors on a late payment that you think is not correct. But the key here is that if you get your credit report in advance, you will avoid surprises at time of your mortgage application, and that in and of itself can be a source of stress because you don't want to blindside yourself with a bad credit rating when you thought everything was good, or a lot of debt that is showing up there that maybe you don't have bad credit, but maybe you co-signed for somebody else and you forgot about it and it's showing up. Bottom line is, try to get a copy of your credit report way before you go get a mortgage application, and make sure that everything is okay and that there are no mistakes on it. That way you can go into the process knowing that when the lender pulls their credit report on you, you already kind of know what they're going to see before they actually pull that credit report. One of the most important financial metrics that banks rely on to determine creditworthiness is something called a debt to income ratio. Now, this is important because basically the bank is looking at your monthly debts and comparing it to your monthly income and coming up with a ratio, a percentage. And that percentage is typically going to be associated with an underwriting guideline that maybe says on their books that for this type of loan, for this type of credit, we don't allow for more than 40-something% of the borrower's income to go towards monthly expenses. That's important that you know that in advance, so you kind of want to gauge where you're at with this number in advance of the application so that you can set realistic expectations and reduce stress, and of course, maybe even enhance the chances of you getting the application approved and getting the house that you want. I'm gonna make it real easy for you guys. All you guys need to do is get a calculator. It doesn't have to be one of those super old financial calculators that are very difficult to use. I'm gonna leave a product link to the video description down below. It just goes direct to my Amazon affiliate link where you can buy a financial calculator that is actually very easy to use. In plain English, it tells you where to press so that you can basically punch in some quick numbers and it's gonna give you your monthly mortgage payment. And not only that, but you'll be able to calculate your debt to income ratio as follows. Take your mortgage calculator or loan payment calculator. By the way, you could also use some online versions of it where you could just punch in information and it'll give you a number. Some of them are a little bit clunky to use if you don't have good internet signal where you're at, so just be aware of that. But I like to use these calculators. But anyway, punch in the numbers and you're gonna get a payment estimate for your mortgage on the house that you're looking to buy. Don't forget to also include the insurance payment and your property tax payment. Everything is gonna be on a monthly basis. Then refer to your credit report and add up all of the minimum credit card payments, automobile payments, auto leases, and other installment loans such as student loans, etc., to arrive at a sum total of all of your monthly debts. Then take that number and divide it by the total of your monthly income. To make the numbers easy, let's just say that the total debts with the mortgage is $2,000 and your monthly income is $4,000. So in that example, your debt to income ratio would be 50%. Now, depending on what the lender's limit is for the maximum debt to income ratio that they will allow, that's gonna kind of allow you to gauge where you're at. Now, I gave you before a number. It's not set in stone by any means. They change all the time with lenders modifying and adjusting guidelines. But as an example, traditionally, if you're within the 40-ish% of debt to income ratio, you're in a ballpark. If you are like at 90% as an example, you're way off. Speak to your lender regarding getting like a heads up as to what the debt to income ratio limits are so that you can kind of gauge where you're going to be when you apply for that loan. And if you need to maybe pay off some debt to get your debt to income ratio a little bit lower to help you qualify. Also, don't forget, guys, that the lenders are going to run these numbers no matter what. You don't have to do this, but if you do it, you're going to at least be able to get into the application process with a little bit less stress because you kind of already assessed in advance more or less where you stand, and you're not going to be totally surprised unless you made a mistake in your calculation or something like that. But the lender is definitely going to be able to help you out with that because they may be able to offer you other products that have more flexible guidelines with debt to income ratio. But regardless of that, guys, you're gonna wanna do this in advance if you wanna go the extra mile to put yourself in a position where you kind of cover all the bases, or as much as you can realistically, without you being a loan expert, and seeing where you stand before you go get a mortgage in terms of your income, your assets, your debt to income ratio, and of course, your credit history, your credit score, etc. So guys, with that all being said, hope you got something out of this video. Stay safe out there, and I will see you in the next one.